Hello, everyone. Thank you for attending. My name is Grayson Geiler. I'm with SES Services. Every week, I like to find a topic in the financial news media and go into a little more description about it. And today, what we would like to talk about is what happened at the Bank of England. Okay, so we've had another pretty wild ride in financial markets over the last week since our last update. And so what happened last week at the Bank of England, and keep in mind, world central bankers talk to each other a lot. I mean, they've been getting it together, trying to coordinate the stamping out of inflation. So interest rates pretty much universally worldwide have been going higher. They haven't at the Bank of Japan, but that's another issue. And the governor of the Bank of England, Andrew Bailey, I think is his name. He was as hawkish as our Fed chairman Powell going into last week about stamping out inflation. Hawkish meaning tighten financial conditions to get a hold of inflation and reel it back in. Lots of the world's central bankers have come up with an arbitrary 2% inflation is what they're gunning for, which doesn't really, it's arbitrary, but that's their target. They're way, way over it, obviously. Inflation numbers, we've talked about frequently. Inflation numbers in England were running over 10%. So the governor of the Bank of England's been very hawkish, trying to reel inflation in. They even raised rates in August, 50 basis points in one shot, which they haven't done in a long time. So their interest rates were coming back up. Well, lo and behold, last week something broke. The gilt, or their version of the U.S. Treasury, the prices came unraveled. So apparently there were some pension funds that were selling the English government bonds for liquidity reasons, maybe for margin call type reasons, posting collateral. They had to sell these, and the Bank of England pretty much had no choice. A lot of people are saying they came in to buy these bonds strictly to avoid a Lehman Brothers moment. So if you remember, rewind to 2008, hear the financial crisis. It was Lehman Brothers that became kind of the poster child for that economic meltdown, financial market meltdown. Even though there's so much running into it and so much other than Lehman Brothers. But that's where the term came from. The Bank of England didn't want a Lehman Brothers moment in England, so they were in there. They broke ranks, and instead of being hawkish, they turned right back around and started the QE, or what we call quantitative easing. So they started buying the British government bonds to stave off a meltdown. Plain and simple. So, of course, that begs the question, what does that do to our financial markets? Well, last week, when the Bank of England came out and started buying, we had a wild rocket launch. This is our 10-year Treasury price. Remember, the price of bonds goes down, the yield on those bonds is going up. So people were starting to worry about running over 4% in the yield of the 10-year Treasury. Well, this is the day the Bank of England broke ranks and started buying their treasuries. So people that were short our treasuries had to buy back. It's a wild rocket launch in asset prices last week. And then the next day, we simply had some economic numbers specific to employment data that looked like the Federal Reserve was going to have to keep marching forward on raising rates to continue the fight against inflation. If employment numbers aren't backing off, well, the Fed's going to have to keep raising. So the markets turned right back around the next day and melted down. Stock market putting in new lows towards the end of next week. It was the end of a quarter. We had September 30th. Last Friday, so that's the end of the quarter. A lot of people shoring up their balance sheets, and it was just time to sell. So the quarter ended very, very poorly, and lo and behold, the financial press starts going this weekend, and everybody's advising or appealing to the Federal Reserve saying, hey, you guys are going to break something here if you keep going at this rocket launch pace. Well, as it turns out, Nick, and I can't even pronounce the guy's last name, who's become kind of the mouthpiece of the Federal Reserve, if he's tweeting it, it got the okay of Chairman Powell for him to actually put out onto Twitter or into the financial press. Well, he came out this weekend and was talking about how the Fed probably went too far too fast. So that is almost as good as Chairman Powell saying it himself. Consequently, the market turns around this morning and really rockets a big relief in the financial markets today. Because again, people are assuming that the Federal Reserve is going to back off a little bit and not keep raising rates at the breakneck pace that they have been. There's a whole lot of fear has been baked into financial market prices because of the pace and the hawkishness of the Federal Reserve. People starting to fear that something was going to break here, just like it broke at the Bank of Japan and at the Bank of England. So the good news is, for the near term at least, we can at least breathe a sigh of relief. Some pressures come up off the markets. I would submit, and in our weekly writing, we've made very clear that, hey, even the concept of a Federal Reserve, one entity setting interest rates for the entire world's economy, doesn't matter who's running it, they're going to make mistakes. It needs to be more of a marketplace, but that's not the situation that we're in. We're very disappointed. We were very disappointed last year how the Federal Reserve had really engineered this inflation unknowingly. But it was pretty obvious that it was going to come. It came, and now they've done a 180 and they've really started raising rates really fast. So we'll see what that means going forward. We've had some economic numbers that have come in pretty tight. I mean, just as an example, the residential housing market prices have been reported at the quickest decline since 2009. So that's getting some people's attention that, hey, the Fed will be looking at these numbers and will back off, won't continue raising rates like this. So that's some of the drive of this morning's and this afternoon's rally in all the financial markets. And again, if you have had a tough time sleeping, you feel like your portfolio is too risky, you're going to get a nice bounce here. Already have gotten, likely to continue for at least a few days. It's going to be a good time to lighten up and remove the excess risk from your portfolio. Hey, if you've got a well-balanced portfolio, you've got some stock and bond positions that have taken on some heat. They have sold off a little bit, but trying to time the markets very, very difficult. It's a fool's errand in a lot of sense. So, for example, if you had sold last week because things looked so bad, you really wouldn't feel very good about that sale this morning. So keep all that kind of thing in mind. Listen, we are here. If you like our weekly updates, please click the like, subscribe to our channel. Feel free to reach out to us for a no obligation consultation if you do need some financial help. And thanks for your time, and we'll see you back next week.